Sometimes there's partnerships that just make all the sense in the world, and I think that's exactly what we saw today when we found out that Peloton is partnering with Fitbit, which is owned by Alphabet. But this is another fitness watch, a fitness device that is going to get access to Peloton's content through their premium subscription. Very similar to what we saw with the partnership with Lululemon. Now, the challenge for Peloton has been making its business profitable. The company really grew up on selling particularly bikes and then subscription to content that could be used on that bike. Now, there's limits to how many bikes they were going to be able to sell, but that was really the start of the business. They've now gotten into treadmills as well. But I think the bigger vision for Peloton long-term is becoming a horizontal fitness company. And what I mean by that is they're going to make content, and that content, so the workouts that they're doing every single day, can then be distributed through multiple distribution mediums. That's what makes the most sense. Make a piece of content one time and make money on it thousands and thousands of times. That's what software companies do. That's what Peloton needs to do. That piece of the business, it's still its best business, but it isn't big enough or profitable enough to actually make the business sustainable overall. So I want to go through exactly what we learned from this partnership and then put it into context with how Peloton's business is going to run long term and what we should look at from an investment perspective, because I think the turnaround story for Peloton is starting to make sense, but we're definitely not there yet. So we're not going to see the kind of stock reaction that you might see if the company was growing again, but there are signs that things are getting a little bit better at Peloton. So my name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right into what this partnership looks like. This is from Peloton, so a multi-year content distribution partnership. We don't know a lot about the economics of the deal, but Peloton and Google Fitbit have announced a multi-year, multi-country partnership to offer a wide portfolio of Peloton classes to Fitbit premium users starting in early September. There will be 10 Peloton modalities, as they call them. Strength, Pilates, running, boxing, cycling, bar are just a few of those. I think they've got about 18 modalities right now. And content will be added incrementally, they say. There's a little bit of I scratch your back, you scratch mine. Peloton members are going to be able to get a Google Pixel Watch or Fitbit Charge 6 device with special offers. And there's a premium subscription, the Fitbit premium subscription, actually 6 months of that comes with the new Pixel Watch 3. That's what I'm showing here. So $350 is a new watch, and this will come with 6 months of Fitbit Premium. I'm going to get into exactly what Fitbit Premium is. Obviously, all these companies want to have some sort of SaaS angle to their business. They want that recurring revenue source, but this is going to be something that you're going to be potentially interacting with every day if you're wearing this device. It's obviously going to give you then workouts that you can do. Fitbit Premium does have their own trainers. There's just a handful of trainers, so not a lot of them, not a lot of content when you compare it to a service like Peloton. But that's why this partnership makes so much sense. You can see that there's tons of Peloton content. They have classes all throughout the day, and then obviously a long history of classes. So Fitbit users aren't going to be getting access to everything, but this allows Peloton to distribute its content to more places and potentially generate a little bit of revenue from that as well. Now, this is important for Peloton because they have two primary revenue sources. First revenue source is going to be connected fitness products is what they call it. This is their hardware. So you can see that that revenue is a significant amount of revenue, but they're generating negative gross margins or very, very low gross margins. So they've actually improved this a little bit recently, 4.2% gross margin in the most recent quarter. That's not going to keep your business afloat. What is going to keep it afloat is growth in subscription revenue. That's this line item right here, but that was up just 3% year over year in the most recent quarter. So $437.8 million in revenue. That's a really nice number, but you need to have that growing more so that you can get more out of each one of these classes and subscriptions that you're providing. But the gross margin, 68.1%, contribution margin, 72.3%. This is exactly what you want to see growing if you are a Peloton investor. But you need it growing faster than it's currently growing because you add those two margins together. So hardware margins and software margins, you get $309.7 million in gross margin, gross profit for the quarter. Operating expenses were $455.9 million. So there's a mismatch there. You need to do one of two things or potentially both of them. You need to increase that gross profit that's coming in the door. You can do that through these partnerships with Lululemon I mentioned earlier. This one is with Google and Pixel, and you need to lower those operating costs. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The reason this makes sense for Fitbit is they don't want to get into the content creation business. They want to just leverage the content creation that's already existed. They just want to sell hardware. And this is where you get into concepts that I talk a lot about here on asymmetric investing, like the smiling curve. One of the theses that I had in buying shares of Peloton was that they were going to be the winner in fitness content. So if they were the company that had the most subscribers in fitness content, they were going to generate the most value because they would be able to get the most distribution. I think they have definitely won that battle. The problem is there's not enough money to be made for that to matter for investors. And the balance sheet was just weighing on the company. So I think the hope now is you not only build a decent sized business with Peloton itself and the subscriptions that you can sell through Peloton to people who own pieces of hardware, to people who don't own pieces of hardware and just want that Peloton subscription, and then also leverage other hardware companies. So Fitbit is one perfect example. Garmin would be another one that would be an interesting partnership. They don't want to get into the content business, but they do want to get into the subscription business. So that one would make a lot of sense. I think companies like Nautilus as well would do a lot of good by partnering with Peloton on the content side. And so that's what creates that flywheel, increases the number of subscriptions. The value of those subscriptions goes up as you add more content, more modalities, and makes the subscription stickier and more valuable to more and more people. That's the way an internet business should work. It's not the way that Peloton has worked quite. That's not quite how it's worked out for Peloton recently, but that's at least the bullish theory for the company. So that's why these kinds of partnerships are, I think, steps in the right direction for Peloton. Probably need to have a few more of them because I wouldn't be surprised if not a lot of revenue is flowing back to Peloton. The premium subscription right now is about $10 a month. Wouldn't be surprised if there's only a couple of dollars a month that is actually coming back to Peloton for all of the content that they're providing. But that is incremental margin. So that's where there's a positive for Peloton, is that every dollar that they can get from Fitbit is going to be a dollar that they can basically put in their pocket. So we'll see what results look like, not only in the next quarter, but in coming quarters as well. Peloton recently went through a restructuring. So restructuring their debt in particular gives them a little bit more runway, but doesn't fundamentally change the problems that they have in making money from the core business and then paying off that debt over time. Strategically, I like what Peloton's doing, but it definitely hasn't paid off for investors yet. So let me know what you think about this partnership and Peloton's future. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you next time.